Good afternoon and welcome to our webinar. Title of the webinar today is Legging in for More Return. My name is Mike Phillips and today is June 3rd. Now when we are talking about legging in for more return, we're not talking about getting in the fountain and going for the coins. That person in the picture actually is Kristen Bell, an actress. Anyway, as I said, my name is Mike Phillips. Been with Power Financial Group for about 7 years. I have an engineering background, business background, worked for a couple successful startup companies, and I'm also the co-author of the book Iron Condor Neutral Strategy for Uncommon Profit. Today we're going to talk about covered call. This is one thing we talked about in our last webinar. We're going to cover some of that again briefly, but if you weren't in the last webinar, you might want to go and watch it. It's on our website. It's also on YouTube. Now, covered call. The first thing on a covered call is you purchase stock, or you can actually have an existing stock as well, and then you sell a call option against it. And a covered call is kind of like if you bought a house and then leased it out to someone and gave them the option to purchase the house. The profit loss for a covered call looks like this. And as you can see, the profit of the covered call is kind of capped out. But we'll talk a little bit more about that. The nice thing about the covered call is that it does have some downside protection. So when you enter position, even if the stock goes down, there's potential that you can make money. Now, one thing that we do a lot is manage covered calls, and what that does, see that area in the orange, it allows you to increase your return. It's not capped. If the initial position is capped, but if you want to manage it, then you can increase your return. There's a couple of ways that you can. One of the drawbacks to the covered call that people mention a lot is that because of the cap, even if the stock goes up significantly, that you're capped. And a couple of ways you can kind of get around that is without them out of the money covered calls, which we talked about a little bit last time, and then you can leg in, which is what we're going to talk about today. Our example we're going to talk about today is one that we posted for PowerOptions Applied, the titanium trade folio, and we posted it on March 22nd, 2011. Now, titanium is a trade folio, and it's covered calls for stocks. We post 2 to 8 new positions, a month, and we try to have 20 open positions at a time. The titanium, when we search, we use our sister website, PowerOptions, to search for the companies for PowerOptions Applied. And some of the constraints that we look for quality companies, S&P 500. We look for companies that are in an uptrend, and we look for companies that have taken a dip. And the reason we like to look for companies that have taken a dip is that there's a greater chance that a stock's going to go up if it's taking a little dip than if you try to chase a momentum, especially on blue chips. Now, there's cases in other stocks where you can try the momentum play, maybe small caps, but in blue chips you really want to try to play them on the dip. The other thing that we do is we look for companies that pay dividends. And the reason for that is as the price of the stock goes down, the dividend yield goes up. And so I did some research on this with our backtesting tool and found that dividend stocks tend to put in a bottom faster than non-dividend paying stocks. And the reason is because there's dividend investors that once a stock's yield gets to a certain point will step up and purchase the stock and help put a bottom on it. Now, on the PowerOptions site, the way that we look for S&P 500 companies is in the recommended lists we put S&P 500. To find stocks that are an uptrend, we set the simple moving average. We look for moving average, 100-day moving average that's greater than a 200-day moving average. To find stocks that are paying a dividend, we look for stocks that have a dividend yield greater than 0. And on this particular day, on March 22nd, we did a search. And in this particular case, I'm not doing a Bollinger Band. I just want to kind of show how this works. We also look for Bollinger Band. I'll talk about that more in just a second. But have a number of companies here, but some of these aren't on the dip, and so we want to find companies that have taken a dip. And to do that, we set the Bollinger Band, and in your search you'll find the parameter called %VB20. That's the Bollinger Band, and what we want to do is set that to be, less than maybe 20 or 30. In this case I used 10 just as an example. And what that did was that filtered out all the companies except for this one that has taken a dip, and we'll look at the chart in just a moment. Before we do that though, I want to talk about, if you see when you do a search in PowerOptions, there's a couple parameters that you want to always look at, and that's the % if unchanged and then the % if assigned. Now, % if unchanged is the amount of return you would make at expiration if the stock price hadn't changed. % assigned is the amount of return that you would make at expiration if the stock were assigned or called away from your account. In this case, the % if unchanged and assigned is 0.3%, which is very low. Normally when we're looking to do a covered call, we like to look for at least 2%. Now, part of the problem with that is that this particular company, Quest Diagnostics, the price is at $53.83, and there's not a strike near $53.83. There's one at 50 and there's one at 55. If there were one at 52.5, say, on that day, then we would have seen probably a nice return for the covered call. So we wouldn't want to enter this position as a covered call because there's not any return. So, but what we can do is we can leg in. We'll talk some more about that in a moment. But the trick for legging in, or one of the tricks for legging in, is that you want to make sure that when the stock does get increases to a price where there's a strike, you want to make sure that you'll be able to make a return. And one thing you can do is you can look at the implied volatility. Now, I've done some research on this, and what you want to do is you want to search for companies that have an implied volatility that's greater than 0.5, and you can set that in PowerOptions search. You can set the implied volatility to 0.25, not 0.5. And then when the stock price does increase and gets to a strike, at the money, then you'll see a nice return generally. I won't say this works every time, but it works pretty well. Now, this is the chart for the DGX Quest Diagnostics. The blue hash-like chart line is the actual stock price, and then we have the 20-day moving average, and we have a lower Bollinger Band and upper Bollinger Band. I'm not going to really talk too much on that today. We talked pretty much a lot about that in the last webinar. If you want to learn more about that, you can pull up the last webinar and watch it. But what I wanted to show you is that the price of DGX was near the lower Bollinger Band. You can see right there it is. Another thing that's nice about DGX is that it's also near its previous support level, kind of. I mean, it's not a real significant support level, but you can kind of see a little bit of support level there. And we like to also do that. We like to get into stocks that are, close to their previous support level. And the reason for that is that tells you that the last time the stock took a dip, there were some people willing to step up and buy at that support level, and there's a good chance that they'll do that again. Now, when you are investing with stocks, whether you're doing options, however you're doing, if the stock is an underlying in an option, you always want to do some research. And one thing you can do is you can listen to the company's conference call. You can there's also text of conference calls on the internet for some companies. You can read their annual reports or quarterly reports. And so I looked at their conference call, and they were announcing they're acquiring a smaller rival. They're going to continue to repurchase shares. Now, when companies say they're going to repurchase shares, that's a good sign that they think their stock price is cheap. Otherwise, they wouldn't buy it. And they also had some new things they were working on. You want to make sure, companies aren't stagnant and they're doing some new things. One of the negative points, and that's probably why their stock price had taken a dip, is that there was some issues with the Medi-Cal program, and and maybe some overcharging. But a lot of times what I found is, especially on S&P 5 companies, is that news like that is usually overblown, is that the news is not as significant as made out. Now there's exceptions like Enron, WorldCom, some of those. Sometimes the news is really bad. Some positive things, we like to look at companies' fundamentals too, is that the company had a relatively low PE of 13. We'll try to stay away from, especially blue chip companies, try to stay away from PEs, like greater than 20 or 25. Had a low price to sales ratio. We want a low price to sales ratio. Member of the S&P 500, so it's a good company. Has a dividend yield, and of course the negative we already mentioned. So we purchased DGX, and we purchased it for $54.28, and we did not sell a call option. We didn't do a covered call. Now, when you do this legging in strategy, you don't have initial downside protection, and you also don't have the time value to decay. So that's kind of two negatives, but the positives sometimes outweigh the negatives. Another thing that you want to do when you're doing this leg in is you want to see where this stock had resistance level. And you can see the last time the stock zoomed up, it had a resistance level of about 59. So what that tells me is that when the stock gets up in that neighborhood, that's when I want to sell the call option. That's when I want to leg in. So that's what we're going to do, is when it gets up in that neighborhood, we're going to leg in. And so that's what it did. So on April 6th, the stock was around 58, and we legged in. So we sold the May 60 call option for $1.10 against the stock that we had already purchased. Now the current stock return was already at 7 or 8%. Now by doing this legging in, we now have an unchanged potential return of almost 10% and an assigned potential return of almost 13%. And the position expires in about 30 days. Now what we did was, on April 28th, we decided to roll the position. And the reason we normally roll positions is because the time value for the current position, I'm not going to talk about time value today too much, but it's kind of your profit if you think of time value. And excuse me, but the time value had decreased to a point that when the time value decreases for a covered call position, you either need to get out or roll it. In this case, we decided to roll them. So we closed the May 60 that we were in, and we sold June 55 for $2.19. We got a net credit of $2.08. Now our new assigned potential return was 7.2%. Now also, as I said, the company pays a dividend, and on April 19th it paid a 10 cents per share dividend. So that's a positive for our return. So now the assigned potential return is 7.4% due to the dividend. Now what we did was, on May 26th, we exited the position, and we don't normally do that too much, but in this particular case we had the same situation. The time value there wasn't much time value left, but there weren't any positions really to roll to that also had any time value. So I mean, we could have probably just closed the call maybe and waited for some appreciation, but in this case, usually when we're in a position for a month maybe, we just go ahead, and if it gets in a situation like this, get out. And there's other investments out there. We don't have to just stay with DGX. We can look to see what else there is to put the money into. As an analysis, the covered call position had a return of 6.7%, and if someone had just purchased the DGX and went long, they would have made like 5.4%. And that was in a time frame of about two months. So we had, about a little over 3% a month. Not too bad. Now in retrospect, you can see we bought the stock here, and then we sold the call here. And in this case, what I was hoping was that this, not hoping, but was kind of waiting to see if it would happen with this, if the stock price would kind of get down back near its previous support level, but it didn't. It came down about halfway and then zoomed back up. So in retrospect, what I would like to have done would have been to close the call option here and then take advantage of the stock appreciation, or just get out. Either way. Now, titanium is covered calls for stocks. As I already said, we support auto trade. Mostly we support auto trade with Options Express. We work very closely with them. The trade folio is continually managed. When there's bad news, we look to see what companies are in our trade folio that maybe we should close. So when the tsunami happened to Japan, we closed some positions. When we had the oil spill in the Gulf of Mexico, we closed some positions. Many positions pay a dividend. We don't include that in returns. It's kind of difficult for us to do. But the other thing is that we don't really consider commissions in our returns, and so hopefully that balances out. As I said, we had 20 positions at a time. We also support what's called safety net. And safety net, what we do with safety net is it's kind of like a put insurance, but instead we're using VIX call options. And if you look at the VIX, the blue is the price for the VIX. You can see that it moves counter to the SPX, which is in green. So you can see when the SPX dips, VIX shoots up. So what we do is we buy the long call options. And so if the SPX dips, if the market dips, then the VIX call option will zoom up. And you can see in this chart near over to the right side, that's kind of back when the credit crisis, Lehman and all that kind of occurred, that if we had if we had bought some long VIX calls around the 1st or middle of April, we would have done really well. Even though our portfolio dipped, the VIX call options would have acted as insurance. The way I like to think of this is, instead of buying insurance for one stock, we're buying insurance for a portfolio of stocks. This is a screenshot of our website, and one thing I want to make sure you do is we have a free newsletter. So if you're not subscribed to any of our services or the free newsletter, you can go to the website at PowerOptionsSupply.com, put your name and email address in there, and you can sign up for the newsletter. And we give away the safety net. So if you want to sign up for the newsletter, you can get the safety net for free. Titanium is $70 a month. We also have a large discount, about $700 a year. We have a trial offer. If you're not happy within 30 days, let us know. We'll give your money back, no problem. We have a number of other trade folios. We have palladium, which is similar to titanium, but we also do collars, and we do this on ETFs. The reason we do collars on palladium is that sometimes the underlying that we use for palladium are the leveraged ETFs. So a lot of times on the leveraged ETFs we'll do a collar. A collar is basically just a covered call with a put, and so you have some insurance. We also have 3 other neutral strategies. We have chromium, optium, and quantium, iron condors, double diagonals. We also have what's called plus, so you can get everything if you want. It's about it's $180 a month, or about $1,400 a year. And this is an excerpt from one of our customers. He was very happy with our returns. So if you want to send us an email, you can send us an email at support@PowerOptionsSupply.com. You can call us. If you can call us toll-free in the U.S., 877-992-7971. If you're outside the U.S. or in the U.S., you can call us at 302-992-7971. Also want to talk about PowerOptions, our sister site. That's what as I mentioned, that's what we use to do the searches for PowerOptions Supply, and also to manage positions. And for PowerOptions, you can get that for $60 a month or $600 a year. Oh, just need to upgrade these prices. We've gone up on our prices like a nickel, so not much. So I think it's 60 instead of 59.95. It's 60. I need to remind myself to fix this slide. We just did that in the last week or two. So the real time is about $80 a month, $800 a year, and then we also have the real time plus back testing. Now the back testing is real nice because that you can go back in time and analyze option strategies and positions, and that's one of the things that I use. I said I did some research on volatility and on dividend yield, and that's the tool that I use to do the research for that. And then I want to show you on the screen over here, like right there is where the percent, if you want to do the Bollinger Band, if you want to do a recommended list, if you want to do S&P 500, you can do that right there. Let's see if I can find, there's the implied volatility that I mentioned. If you want to set that to 0.25. And if you want to contact PowerOptions, you can email at support@poweropt.com. Not PowerOptions, but PowerOpt. Same phone number. Website's www.poweropt.com. All right, let's see if my co-pilot's out there, if we have any questions today. Mike?
Yes. I'm sorry. Yes, I'm here. We do have a few questions that came in, and I was thinking that what we might want to do is just, since we still have time left in today's presentation, we might take 10 minutes or so just to show some of the PowerOptions tools after the questions, and maybe even look at the back testing very quickly, just as a show there. Now, excuse me, the first question that we had coming in during your presentation was from David. And I answered David through text, but you would probably want to answer this as well.
Okay.
David says, radioactive guy, he means Kurt, of course, Kurt Frankenberger, radioactive trading, said covered call trading is a bad trading method. Now, in general, my response to David was that covered call trading sometimes by itself, if approached the wrong way, is bad trading. And that's what Kurt is discussing against, that most people who trade covered calls or teach covered calls teach you to look for returns of 4, 5, 6%, looking at the extremely more volatile stocks that maybe don't have a lot of good fundamentals, and that's where investors get into trouble because they're looking for these high returns on these volatile stocks that have inflated premiums, and these are the stocks that tend to fluctuate more wildly. Now, Mike, what are your personal thoughts on comparing covered calls to the radioactive trading, the Mary put technique?
Well, I think all strategies have advantages and disadvantages, and that the covered call, in a bullish type market, it makes sense. I wouldn't want to do it in a bearish market unless I was doing it on the inverse ETFs or something like that. So there's markets where it makes sense, there's markets where it doesn't make sense. And the other thing is that you want to, at least for us, we focus on blue chip companies. We don't go after the biotechs and that kind of stuff. I wouldn't even attempt to do a covered call for a biotech, but yet I would use the radioactive method to do a biotech. The other thing is that the radioactive method is insured, but this method we're also doing an insurance, just a different way of insurance. We're using the VIX call options, and we're insuring against a market meltdown as opposed to a single stock meltdown. The other thing that we do is we have like 20 positions, so we've spread our risk out across 20 positions. So if we do get one position like an Enron, we won't get hurt too bad because we have the other ones. If I have a portfolio of $100,000 and I have 20 positions, I might get hurt 5% by a Enron, but yet I can make that up in a couple of months with the covered call strategy, so we can recover from a really bad experience with something like an Enron.
Okay. Now, Joe wanted to know, in regards to what you mentioned about the safety net that you use for all of the trade folios on PowerOptions applied, he wanted to know, do you use straight front-month VIX long call options or spreads for your portfolio insurance?
We do use the 1 month out VIX call options, right?
Mm-hmm. Okay. And Lloyd wanted to know during the presentation, Lloyd wanted to know, why did you roll the position? And I think you addressed that, but I just saw
well, that was because the time value had decreased. Usually when the time value for a position gets to less than 1%, we either get out of the position or we roll it. If you're in a covered call, it makes no sense to hold a covered call position where the time value has decreased, because the only thing that can do is you can lose money. You can't make very much. I mean, the amount of money, additional money you can make is very little. I shouldn't say money, but return is little. But then there's a big downside. So you either roll it or get out.
Okay. George, Lloyd says you lost some by rolling, meaning that I guess you paid into some of the time premium to roll the position, and he's saying that you lost some premium when you rolled the position.
Well, we did roll down, but when I did roll down, we actually increased our time value. So we went from a position with little time value to one that has time value. I mean, could we have made a better return if we'd have gotten out at the peak? Yeah, absolutely. But the thing is trying to time the peaks is pretty hard. So what this strategy allows you to do is if you sell the call at the peak, so if it does go down, you make money on the call, and if the stock keeps going up, you make money if going up too. So this way you can make money going up or down, whereas if you just get out at the peak, you don't make any more money if it keeps going up, but you do avoid, the downside. So.
All right. On those lines, Sue wanted to know, well, in that approach, what was the advantage of rolling as opposed to just letting expire worthless? Why not just let it expire worthless?
Well, there's time between, expiration. I don't remember how many more days were left till expiration, but if something bad happened, you could lose money, but you couldn't make any more money. There's no reason to hold a call option with little time value. The other thing would have been, and as I mentioned, is that I could have closed the call, which didn't have any time value, and just held the stock. But I didn't really want to do that. For me, it's when I'm in a position for 30 days, 40 days, 50 days, I'm ready to take my money and go find another vehicle. So that's what we did. We took the money out of DGX and I added another position. And so hopefully when that position works out, if it does, in the next couple months, we'll do a webinar on that one. And I can show that. I can show we closed DGX and we went with a different position.
All right. Now, George wanted to know, sorry, I think George might have come in a little bit late, but what is the difference between PowerOp.com and PowerOptionsApplied.com?
Okay. PowerOp.com or Power Options is for like self-directed investors that want to do their own search. So they go and they can use our tools, our search engine, and find their positions, put the positions on at their broker. PowerOptions Applied is we do all that for you. We do the search, we do the management, and if you have auto trade with mostly we use Option Express, but if you have auto trade set up, the trades can be automatically executed in your account, so you don't have to do anything except watch us do all the work. So that's the main difference.
Right, and Power Options has tools to, once you identify the positions, and we're going to walk through that in about 5 minutes. We're going to go through that. We're going to create kind of what some of the criteria that Mike pointed out. We're going to pull up the Power Options covered call screen. We're going to walk through how you might set in some of that criteria. We're going to save that search and then open up the back test and just run historically. And this is what Peter wanted to know. Peter wanted to know, how did you find DJX? He missed the first 5 minutes. And Mike Phillips used the Power Options tools, Peter, to identify that position when he was entering the trade for the Power Options Applied customers. And Mike, of course, if they don't have auto trade, you notify your customers at Power Options Applied of the trades through email and through Twitter as well, I believe.
That's right. We also do Twitter. So if you want to get a notice to your cell phone, you can. Then you can log into the website and you can see the trades on the website as well.
Okay.
And we have a number of customers that trade for their own account. They don't have auto trade. But we do also have a number that do auto trade as well.
Okay. Now, Bill has a question here. This is a little bit more advanced. With the VIX volatility index very low right now, are you finding it more difficult to find quality trades with decent premiums every month? And what do you do when the VIX goes lower from here?
Well, I hope the VIX doesn't go lower from here. Otherwise, it'll be hard for us to be in business. It's option trading is, if the volatility goes to zero, then there won't be many option traders.
We won't have any time value.
Yeah, exactly. I mean, there's enough volatility in the world to make option traders, to help option traders make a living. I mean, unfortunately, there's tsunamis and earthquakes and hurricanes and political, all kinds of things going on all the time, economic issues. So I don't really see volatility going to much lower. But it does make it more interesting to try to find, positions that have a decent return. And that's one reason that I like this, legging in strategy, is that even if you get in a stock at the bottom and you buy the stock and then it goes up, and maybe it goes up and there's not, and there's not a call, maybe there's not an attractive position to leg into, you still made money. So.
Okay. Demetrius would like to know, hi Demetrius, it's good to see you online, but Demetrius wanted to know, could you explain a little about what you do with the portfolio, the titanium covered call portfolio, when the market goes down? Maybe let's say you're in an extended bearish cycle.
Well, if we were in an extended bearish cycle, and I did this previously, we also have palladium, which is covered calls and callers on ETFs, and I actually told customers that the market is bearish. I would suggest you switch from titanium to palladium, and then we can do covered calls on the inverse ETFs, and we did that. We did covered calls on
and the
ETFs.
Collars, yeah.
Right.
So Leonard,
let me say this: when the market is bearish, I would not do the covered call strategy. I would do something else. You could do it on inverse ETFs, or you can do, try to do some of the neutral strategies, Iron Condor, or the double diagonal, something like that.
Leonard has an interesting question, and I've asked this question before of you too, because we had this actually. Leonard wanted to know, do you ever consider naked puts in lieu of the covered calls?
Yeah, we actually had a naked put strategy at one time. It was called Stratium, but it wasn't very popular. The covered call, it's more well known, and when people start doing option trading, for some reason, covered call is the one they levitate to. I think for one reason it's very conducive for people that have already been doing stock trading, and they've already been buying stock. And so now they say, oh, well, I'm going to sell some call options against my stock and make some income. So it just seems to work out that way. I actually like to enter positions with a naked put over trying to get in with a covered call, because you can set a limit price, and it's a lot easier to kind of get the price that you want. You can still, on a covered call, you can set a net debit and kind of do a similar thing. But one kind of disadvantage, though, that for the naked puts is that you don't get the dividend that you do with the stock. So if you like, and which I do, I like to do covered calls on dividend paying stocks. I like to get the dividend. As you saw, it increased our return, and if we'd had a naked put, we wouldn't have gotten it, the dividend.
Okay. All right. Now I just answered a question for Peter. He said, so for example, were you protected in your trades with the market drop we just had the last couple of days in the titanium trade folio?
Well, we were protected, but the VIX call options is really for really drastic market drops. It's not for these intermediate market drops like this. I wouldn't consider the market drop that we've just gone through to be that significant. I mean, we're talking, really drastic market drops. The
Black swan events.
Yeah, you know, you can do like a put option to protect, but I did some research and found, you know, put options actually will do better in a you know, for these minor kind of market blips, the put options will do better. But when you have a really significant market movement, the VIX call options will outperform the put options. So, and the other thing is the put options are kind of expensive compared to the VIX, you know, call options. What you get when you get in a, you know, a low volatile market like this, the VIX call options are pretty cheap. You know, if we were in a high volatile market, then, you know, I might consider doing, you know, buying the put instead. With the way the market is, the VIX long call really make a lot of sense.
Okay, I'm trying to clarify a question here from Roy. And is that Roy and Patricia? Yeah, Roy and Patricia. He wanted to know, is it possible to do covered calls using leap calls, and what are the advantages or disadvantages? And what I want to know is, are you referring, Roy, to doing diagonal calendar spreads by buying a leap call and selling short calls against it, or are you referring to buying stock and selling a 10 or 12-month out call?
Well, I'm going to guess that he's talking about, instead of purchasing a stock, purchasing a leap for a call option that's out in the future. That's a pretty advanced strategy that I don't want to talk about today, but my personal view on these diagonal trades, that if you want to learn how to do a diagonal trades, try to start with, you know, the double diagonal, something like that, instead of trying to do, you know, a calendar call type strategy.
Yeah, the diagonal spreads, they can be useful in reasonable markets. Mike, actually, before you started working here at PowerOptions, or right when you started working here, I was trading a lot of diagonal spreads in my personal portfolio, and I had a good run, but with the leverage, it worked against me. So after maybe 8 or 9 months of good profits, I had 2 months of 50-50 mixed trading, and I'd almost given everything back to the markets. And those diagonal spreads are leveraged, and you have to be really careful with what you're risking in your portfolio and what you're risking in those positions, because as the market stagnates or it turns, it can come back to haunt you.
Well, that's the reason I like the double diagonal, because it's neutral, and so if the market takes a minor blip, you know, up or down, you don't get hurt. You know, the other, you know, you have 2 legs, and so one leg compensates for the other leg, and then you can always roll the diagonal spread to a non-diagonal spread, you know, or even roll the diagonal to a condor. So there's a lot of flexibility in that strategy. So that's what I would recommend before trying to do a calendar call by itself.
Yeah, and Roy wrote back and he says, yes, calls that are 10 months out. So just comparing the other two, if you're looking to do, while we're here, if you're thinking about doing covered calls, you look at a call that's 10 months out in time. Well, what are the advantages? Number one, you receive a higher premium, and you have a higher downside protection if you use covered calls and you're selling calls that are 10 months out instead of the near term. The problem for me doing that has always come in the management. You don't get to see the time decay that Mike was looking at, that time value decay, to effectively roll the position until you're 2 months to expiration or 3 months to expiration. A lot of customers I've seen, Roy and Patricia, through the PowerOptions during coaching sessions who have calls that are 8 months out, they see the stock fluctuate in the near term, and they say, well, how can I roll this position? It's much more difficult to adjust it if you have a call that's 10 months out that's not really losing value in your favor. It's not losing time value in your favor because you're not within that 2-month period of expiration when the time decay starts to rapidly fall off. Also, that being said, you always get a better annualized return selling month by month by month. Yes, the premium when you sell a 10-month out call is higher. It might match your needs. That's fine, selling a lead covered call position. But you'll always get a better annualized return if you're able to sell month by month by month and roll the position, because you always receive higher time premium over the shorter time frame.
Exactly. Mm-hmm.
Mm-hmm. Okay, now, Mike, I want to steal the screen from you very quickly.
Sure,
Please,
go
ladies
ahead.
and gentlemen, if you have any other questions, send them in. But Robert did have a question. He came in late and wanted to know, is this presentation going to be archived? And yes, it is. And I want to show everyone right now. 1 second here. Let me steal that from you. And I want to show my, there we go. There it is. Hold on 1 second, ladies and gentlemen. Ta-da. Okay, now, what I wanted to show you, Robert, is where it's going to be located and where you can get part 1 of the presentation that Mike Phillips presented last week, or 2 weeks ago, I believe. So if you're on Power Options, you want to navigate from the home to the Learning Center. And then from the Learning Center menu on Power Options, click on Webinars. And this will take you to the Webinars archive. Now, this is a public page, by the way. This link up here that I'm going to send to everyone right now through the chat window, powerop.com/webinars.asp is a public page. What I did is showed how you would navigate to it if you're logged on to your Power Options account. For those of you who may not have a Power Options trial right now or a subscription, there we go. Let's send that to the entire audience there. www.powerop.com/webinars.asp. It's a public page. You can access all of our archive presentations. Down here, we have the Power Options Applied Archive. And the first one listed is Beating the Market with Blue Chips on the Dips and Stock Options. That was Mike Phillips' first presentation, and he touched a little bit on today. And our presentation today, this presentation today, the legging in, will be available hopefully later this afternoon. We're going to try to get it up on the Flash. We'll definitely have it up here in the Flash mode, and then try to get the YouTube link up as well. So just go navigate to powerop.com/webinars.asp, and you can click the header for Power Options Applied Archive. Here's part 1, and then the legging in presentation that we're doing right now will be available later on this afternoon. At least one form of it will be available later on this afternoon by 5 p.m. Eastern Time. And of course, feel free to go through some of our other ones, the Power Options Tools Archive. Mike Phillips talked about the historical suite of tools, and there's a presentation here on using the historical suite of tools as well for the different strategies, so you can go through that also. All right, now, for those of you who do currently have a Power Options trial, a Power Options subscription, and those of you who are considering signing up for a 14-day free trial, as we mentioned before, Power Options Applied, that's where Mike picks the trades, and for the different trade folios, sends out the emails when trades are made. And Power Options, powerop.com here, this is more designed for self-directed options investors. We support over 23 different strategies, so if you want to identify the positions. Now, Mike, why don't you go ahead and walk me through some of those settings you went through. So if I go to the Covered Call tab, and I go into the search tool,
Okay.
it's going to pull up one of my default searches that we have. I believe this will be the initial values at the money screen.
Okay.
As I'm actually looking at the in the money covered call screen. But what I want to do is, if you're looking to create a new search, the easiest way to create a search is just scroll all the way down to the bottom, ignore the default settings, and hit clear these settings. That'll empty everything out of the portfolio field. And we'll start off on the left. And right now, Mike, would you still be looking at June, or would you be looking at July, or would you be looking at a time frame of maybe 10 to 45 days?
I would probably go for July right now. We're getting pretty
Okay.
close to expiration for June.
Okay. So I can select June and
Especially
July.
with the low volatility.
Right, right, good point. But, and we can also expand it, so if we wanted to look at June and July, we could select all months and then use the days to expiration. We could put in 10 to, let's say, 65 days out, so anything within that time frame would come up in our results. If by chance there were any June series that matched our other criteria, it would appear. Okay. All right, now what are some of the other criteria we'd want to put in, Mike?
Well, we want to put in the uptrend, so we want to do a 100-day moving average greater than 200-day moving average.
All right, so down at the bottom on the SMA, I'm going to select the SMA 100 to be greater than the SMA 200. All right.
And we want to select S&P 500 from the recommended list.
Okay. There we go.
And we probably want to set the percent Bollinger Band. I'd start out with maybe 30, and then we can go down from there in the right block.
Oh, you want to be less than 30. So we're looking at the ones that, as you mentioned, have taken a dip. They're down near the lower Bollinger Band.
Exactly.
Okay. Very good.
I would set the... I usually like to get companies with that are making a profit, so I would set the PE to greater than 0.
Okay.
And
you had mentioned earlier that you usually like to be below 20 or 25.
yeah, I would set the right one to 25.
Okay. That's the price to earnings. All right.
And then in this case, we'll try to see if there's anything, that has let's look for things we can leg into. So I would set the implied volatility to greater than 0.25.
The implied volatility for the option, greater than 0.25. That's in the center section. The center section here is mostly our option criteria.
That's probably a pretty good start.
Okay, now did you want to, let's go ahead and talk about that return. You had mentioned that you at least wanted a percent if assigned of 2%.
Well, when you're looking for legging in returns, you don't want to set percent if assigned or percent if unchanged. Because
Okay, so for legging in, right.
So we're using the implied volatility to kind of screen for that.
All right, and one last trick. Investors can do this on their own, of course, but do you have any preference for stock price in titanium? Do you normally not trade stocks, let's say, over $100 or over $80, for example?
I did some back testing and found that stocks less than 20 do not usually do too well. So I usually put a lower limit of 20.
Oh, okay.
And then our customers usually don't have a, some of them don't have a ton of money in their accounts. So we kind of limit the upper price to maybe 70.
Okay. All right, very good. Now let's just run that search very quickly, and we'll see some potential results here. Okay, so you've got 9 results now. 2 for Tyco, both July. Oh, you were right, Mike. We didn't see any June series that matched that criteria we were looking for here.
Yeah.
And SanDisk and Tesoro. And as you mentioned, of course, these are showing some deep out-of-the-money calls, of course, which have very little downside protection, very little option bid because we didn't filter for that, but we were looking for the volatility value. So this is for legging in. We're not looking at the straight covered call position. These are the potential stocks that Mike might use for legging in. Tesoro, SanDisk, and Tyco. JCPenney, it's usually an interesting stock. DuPont, Western Digital, and Lowe's.
Yeah,
and of course I have
this is the point where, oh yeah, we left out the dividend yield.
Yeah, but all of these except for, well, let's put in greater than 0.
Let's put that in and see. We'll get rid of those.
Okay, so the dividend yield now, we'll just start with a base of greater than 0, so it'll filter out anything that doesn't pay a dividend. And this should narrow us down to about 5 results, I believe.
Yeah. There you go.
Okay. Oh, it just include. I see what it did. Okay, got it. All right. So there's our dividends, and we do have some. The reason why it increases, we have some more. Tyco popped up a couple more potential calls, of course, and Bank of New York joined us, as did Morgan Stanley.
Yeah. Well, this is where the point where you have to go and look at the stock to see, where the support levels are, and look at their conference calls and quarter reports, annual reports, do some due diligence.
Yeah, and then the first thing we normally do from PowerOptions is we link to big charts, of course. Now this is a base chart. I don't have it set up the way that you might want to use, Mike, but you can always use the indicators, and I actually have this set on one of my other screens where I'm looking at the lower indicator of maybe the MACD, but more importantly, the upper indicator, I might have the Bollinger Bands, the MA envelopes, or set the moving average envelopes up top here, or the SMA2 line, maybe the 50-day or the 100-day, as you mentioned, to see that on the chart. And probably I might only select maybe a 3-month or a 6-month chart as opposed to a 1-year chart. So you can customize that once you've identified the position.
Yep.
Okay. And then, of course, as Mike mentioned, some of the other information that you can link to right from here. You have the charts, of course. And the company information and news, you can go to the news, the earnings events, and the profile. When you go to the earnings and events, that's where you can review the conference calls and other information as well.
Yeah, actually, I usually go to news and then search for transcript. And then
transcript, okay.
And then you can find the transcripts of the conference calls if they have them on the internet.
Okay. Now, if, for example, on this basic screen we just showed, we just ran the search, we were looking for legging in, but of course if you wanted to go right into the buy right position, when you set in your criteria, you would just set the minimum you'd want to see for the percent return if assigned or the downside protection, for example, to identify the covered calls that match your criteria. Yep. Now, once you have your criteria set, we'll just go ahead and click Save, and I'm just going to call this Mike Phillips, Titanium Search. And I'm not going to put a description on this particularly, but if you wanted to put a description on some of the criteria that you use, you could just go ahead and enter that as well. And I'm going to go ahead and click Save this search. And every time I log on to PowerOptions, I go into the Covered Call menu. This search, I don't have to recreate it each time. I can still go back to the default criteria that are listed, some of the default searches to use as a stepping stone to create other searches, but I can always come up into this screen as well. Now, the main reason why I wanted to save that is I'm going to go back to the covered call menu, and I'm going to go into backtest. So when I click on backtest, you have the backtesting available, the historical suite of tools available in your PowerOptions account. We can go into the Smart History Excel where we can run searches historically, or we can search by symbol. So if I go into Smart History Excel,
you could actually go back to March 15th.
That's what I was going to try to do.
Okay.
Let's see what we've got. So select my date here, my target date. I'm going to select March 2011. And the minute I select that, it's going to pull up the available number of days in the month. And we're going to run on the 15th. And now it says Save Search. Which Save Search do I want to run off? Well, I want to run off of Mike Phillips' Titanium Search. Now let's submit that.
Hopefully this works.
Now, I might have some different results, too, because remember, I used the 10 to 55 days out in time.
Yeah.
And there are a lot of results that match that base criteria at the time. And you opened an April call, is that right?
Yes.
Okay. So let me just narrow that down. Let me just say April instead of the 10 to 65. Let's clear these out here. Clear those fields out as well. Oh, okay. Nothing. I lost the stock price there for a minute. So March 15th, 2011. And we still have several results here. I guess the implied volatility was much higher at that time. So there were a lot of positions that were matching that basic criteria. Let me do this. How about this, Mike? Let me just for grins, let me narrow that down. This might narrow it down too much, but we'll see. There we go. Okay, so there's still 78 results. And there's Quest Diagnostics. My apologies. I just wanted to narrow it down because we had too many out-of-the-money strike prices. That's why we're seeing so many results. But Quest Diagnostics, 55.21, and then, of course, it pulled up the April 60 call. But you were looking at this as a legging in opportunity. It was down $1.04 that day. See, Aflac took a hit that day of about $3 as well. So you can run the historical screen based on the search criteria, and then what I can do is calculate group results to see how these covered calls performed over the time frame, or research each covered call individually. I can choose to analyze the position or look at the price history or go link to the stock chart, for example, as well. So once you've saved the search, you can go ahead and just use the historical suite of tools, and that's available on the trial. So those of you who haven't signed up for a trial yet, if you want to test out the tools, just go to PowerOp.com, and all you need is first name, last name, and email address there. But the chart here, I'm sorry, shows you your percentage return at expiration, the max percentage return, the minimum return for the position, and this was considering if we specifically sold that April 60 call, which you did not do, of course. You had the different strike call after you legged in. But we can scroll back and look at the percentage return versus the Qs and the SPX over that time frame. And also we can look at the stock last price versus the option price over the time frame from 3/15 to the expiration in April. So it gives you some analysis there, some features that you can use after you've run the historical testing and the historical search as well. All right. Well, I don't see any other questions coming in. I just wanted to show some of the PowerOptions tools very quickly. I sent everyone a link earlier on for PowerOptions Applied. If you just go to PowerOptionsApplied.com, you can read more about the trade folios and the performance at PowerOptions Applied. And when you first go to the site, if you click on Products, that's where I was, and that's the link I sent to everyone. And the Products menu, this will give you a description of each one of the trade folios there, what strategies are being used, and the performance, of course, and what the goals are for each trade folio as well. All right. Mike, did you have anything else?
No, I don't. Other than to tell everybody thank you for joining us, and we'll be doing some more in the future.
And of course, every Friday at 4:30, we also have the open discussion presentations. If you have questions about today's presentations, you can join us today at 4:30 for the open discussion, open presentation. Or if you have questions, you can send them to support@powerop.com, or you can send them to Mike at also support@poweroptionsapplied.com as well. But any emails that come in to PowerOptions, for example, or to PowerOptions Applied, we'll be able to handle those as well. So thank you again, everyone, for joining us. Again, that link I sent you, powerup.com/webinars.asp, that's where we'll have today's presentation archived, and you can view part 1 of the presentation that Mike Phillips put together about the blue chips and the dips and the stock option returns. And so any questions, you can send us a call. send us an email or just give us a call, and we'll handle any of your questions. All right, ladies and gentlemen, thank you very much. Mike, great presentation.
Thank you, Mike.
We'll see you all again soon. Take care,
Okay.
everyone. Good night.
Bye.